There are 665,000 Americans with over $1 million saved for retirement. A new record, according to Fidelity Investments. They are not hedge fund managers. They are not tech billionaires. They are nurses, teachers, factory workers, and accountants. And most of their coworkers have no idea. Fidelity Investments manages over 40 million retirement accounts. Every quarter, they analyze the data. Their latest report shows something remarkable. The number of 401k millionaires has never been higher. And the gap between what they did and what average Americans do is surprisingly small. First, let's understand who these people actually are. According to Fidelity's data, the average 401k millionaire held their account for about 26 years. Their average age is 58. They did not get there fast. They got there consistently. Most have household incomes between $100,000 and $200,000 per year, above average, but far from the salary of a Wall Street executive. Their generation matters too. The majority are baby boomers and Gen X workers who have been saving for decades. But here is the surprising part. Millennials are now entering the club. As of late 2025, around 2% of 401k millionaires are millennials, and that number is growing fast every quarter. The path to $1 million is no longer reserved for people who started decades ago. Now here is where it gets interesting. Fidelity found that these millionaires share 3 habits that separate them from everyone else. The first habit, they contributed consistently, every single paycheck, for decades. The average 401k millionaire contributed between 17 and 19% of their salary each year. The IRS employee contribution limit for 2026 is $24,500. Many of these millionaires hit that limit every year. The second habit, they never touched the money. Not once. When markets crashed in 2008, they held. When COVID hit in 2020, they held. When rates rose in 2022 and markets dropped 20%, they held. The Vanguard How America Saves report found that investors who panic sold in 2008 and got back in a year later had 30% less money 10 years later than those who simply did nothing. The third habit, they took the free money. Nearly every company with a 401k offers an employer match. On average, employers match 3 to 6% of your salary. This is a 100% instant return on your contribution. Yet Vanguard's research shows that 25% of eligible employees do not contribute enough to capture the full match. These people are leaving tens of thousands of dollars on the table every decade. Now let's talk about what they actually invested in. The average 401k millionaire is not picking individual stocks. They are not trading options. The most common holdings are target date funds and low-cost index funds. Target date funds automatically adjust your risk as you age, moving from aggressive growth stocks to safer bonds as you approach retirement. The average expense ratio these millionaires pay is just 0.1% per year. This matters more than most people realize. If you invest $100,000 and earn 7% per year, but pay 1% in annual fees, your net return is 6%. After 30 years, you have $574,000. But if you pay just 0.1% in fees, your net return is 6.9%, and you end up with $723,000. That is a difference of $149,000, just from fees. Here is the time to million formula, assuming a 7% average annual return. If you save $500 per month, you reach $1 million in about 36 years. Raise your contribution to $1,000 per month, and you get there in 28 years. Save $1,500 per month, and it takes 23 years. $2,000 per month, 20 years. The single biggest variable is not how well your investments perform. It is how much you contribute and for how long. The S&P 500 has delivered an average annual return of about 10% over the past 100 years. Even adjusted for inflation, the real return is around 7%. No single decade has ever produced a negative 20-year rolling return. This means if you invested in a simple index fund and held it for 20 years, you have never lost money. Not once in the history of the American stock market. So what can you do starting today? First, increase your 401k contribution to at least capture the full employer match. If your company matches 4%, contribute at least 4%. Second, switch to a low-cost index fund or target date fund if you have not already. Third, automate it. Set it and forget it. The Millionaires and Fidelity's data did not succeed by checking their balance every day. They succeeded by not touching it. The 654,000 401k millionaires in America did not have a secret. They had a system. Contribute as much as you can, as early as you can, to low-cost index funds, and never stop. Time is the only ingredient that cannot be bought or replaced. A dollar invested at 25 is worth 8 times more than a dollar invested at 45, assuming the same return. The best time to start was yesterday. The second best time is today. If you found this useful, hit the like button and subscribe to WealthInFrames for more data-driven financial breakdowns. And remember, this is not financial advice. Always do your own research before making any financial decisions.